Picture two people, same city, same income, same year, 2015. Both of them have $50,000 saved. Both of them want to build wealth. Both of them are sitting at a kitchen table making a decision that will define the next decade of their financial lives. The first person, let's call him Daniel, does what every financial advisor, every YouTube channel, every well-meaning friend tells him to do. He opens a brokerage account. He puts all $50,000 into a broad market index fund, S&P 500. Set it and forget it. The standard advice, the safe choice, the obvious move. The second person, Marcus, does something different. He does not put a single dollar into the stock market. Not one. His friends think he is making a mistake. His brother calls him crazy. His coworker shows him charts proving the S&P 500 returns 10% annually on average. Marcus nods and then does exactly what he planned to do anyway. Fast forward to 2025. Daniel's $50,000 in the S&P 500 has grown significantly. He's proud of it. He talks about it at dinner parties. He checks his portfolio app almost every morning. Marcus does not check an app every morning. He doesn't need to, because Marcus reached financial freedom 3 years before Daniel did. Same starting amount, same decade. Marcus never touched the stock market, and he won. How is that possible? Because Marcus understood something that most investors spend their entire lives never learning. The stock market is not the only path to wealth. It is not even always the best one. And depending on your goals, your taxes, your cash flow, and your life situation, there are 5 investments that can outperform the stock market in ways that no financial advisor's standard pitch will ever tell you. Today, we are going to walk through all 5, not as a list, as a story, because the numbers only make sense when you see how real people actually use them. And by the end, you might question everything you thought you knew about where your money should go. Investments 5 and 4. Investment number 5, high-yield savings and treasury bills. In 2022, Daniel watched something terrifying happen. The S&P 500 dropped 18%. His $50,000 investment, which had grown to roughly $89,000 over 7 years, fell to $73,000 in 12 months. $16,000 gone. Not permanently, but gone for now. And the anxiety that came with watching it happen was something no chart had prepared him for. Marcus, in 2022, had a different experience entirely, because one portion of Marcus's money, $15,000, was sitting in treasury bills, short-term U.S. government bonds. In 2022 and 2023, as the Federal Reserve raised interest rates aggressively, those treasury bills were yielding 4.5% to 5.25%. Guaranteed, zero risk, fully backed by the U.S. government. While Daniel was losing money, Marcus was earning 5% on $15,000, risk-free, zero stress. Here's the part most people miss. In a high-interest rate environment, a guaranteed 5% return is not just safe, it's competitive. The average stock market investor underperforms the index significantly due to behavioral mistakes, panic selling, emotional buying, poor timing. The real average retail investor return is closer to 4 to 6% annually. A treasury bill at 5.25% with zero risk and zero stress is not a consolation prize. It's a legitimate wealth-building tool. The mistake most investors make is treating safety as the enemy of returns. Marcus treated safety as a foundation, and that foundation gave him the psychological stability to make bolder decisions elsewhere. Which brings us to investment number 4. Investment number 4, owning a business. Marcus did not put his entire $50,000 into treasury bills. In 2016, he used $22,000 of his savings to start a small commercial cleaning business. 2 employees, local contracts with office buildings. Nothing glamorous, nothing that makes a good story at a dinner party. In year 1, he made $31,000 in profit. In year 2, $67,000. By 2020, 4 years after starting, the business was generating $140,000 in annual profit on revenues of $380,000. Daniel's entire stock market portfolio in 2020, after 5 years of the greatest bull market in history, was worth approximately $107,000. Marcus's business alone generated more than that in a single year. Here's what the stock market cannot give you that a business can: control. When the S&P 500 drops 18%, Daniel can't call anyone. He can't make a decision that changes the outcome. He can only watch. When Marcus's business had a slow quarter, he hired a better salesperson. He expanded into a new neighborhood. He added a service line. Every dollar of return in his business was connected to a decision he made. The data supports this. According to the Federal Reserve Survey of Consumer Finance, the median net worth of self-employed business owners is approximately 4 times the median net worth of people who work for others at similar income levels. Private business equity accounts for an average of 21% of millionaire household wealth. Stock market makes you a passive participant in other people's businesses. Owning a business makes you the decision maker in your own. But here's the plot twist that Marcus did not see coming. Investments 3 and 2. The plot twist. In 2020, Marcus's cleaning business lost 3 major contracts in a single month. COVID-19 shut down the office buildings he serviced. Revenue dropped 60% in 90 days. For the first time since 2016, Marcus was genuinely scared, but he survived because of investment number 3, investment real estate. In 2017, Marcus purchased a duplex for $180,000. He put $36,000 down, 20%, and took a mortgage on the remainder. He rented both units. The combined rental income was $2,100 a month. His mortgage, insurance, and property taxes totaled $1,340 a month. Net cash flow, $760 a month. Every month, whether the stock market went up or down. When COVID hit and his business revenue collapsed, that $760 a month from the duplex didn't stop. His tenants were essential workers. They paid every month. The cash flow that felt like a small bonus in good times became a lifeline in bad times. By 2025, that duplex, purchased for $180,000, was worth approximately $310,000. Marcus gained $130,000 in appreciation. He had collected roughly $191,200 in rent over 8 years, net of expenses. And he had done something Daniel could not do with his index fund. He had used leverage. Marcus didn't need $180,000 to control a $180,000 asset. He needed $36,000. That $36,000 down payment generated returns on the full $180,000 property. His effective return on invested capital was not 7 or 8%. It was substantially higher because leverage multiplied every dollar of appreciation. Here's the number that changes how you think about real estate. The NCREIF Property Index, which tracks institutional real estate returns, has delivered average annual returns of approximately 8.5 to 9.5% over the past 20 years. But because investors use leverage, borrowing to amplify returns, the effective cash-on-cash return for many real estate investors exceeds the stock market return significantly on an invested capital basis. And there is something even more powerful than leverage in real estate. Something Daniel discovered when he finally sat down and compared his approach to Marcus's in detail. It wasn't the appreciation, it wasn't the cash flow, it was the taxes. Investment number 2, tax-advantaged retirement accounts. In 2025, Daniel sold a portion of his index fund portfolio to buy a car. The gain on that portion was $28,000. His federal capital gains tax bill, $4,200. Gone. Not invested, paid to the government. Marcus, in the same year, made a withdrawal from his Roth IRA. Zero tax. Not a reduced rate. Zero. Here's the math that most people never calculate.
A dollar invested inside a Roth IRA, contributions made with after-tax money, grows completely tax-free. Every gain, every dividend, every dollar of compounding, untouched by taxes for the rest of your life. On a $50,000 investment growing at 8% annually for 30 years, the difference between paying taxes on gains every year versus paying zero tax is approximately $180,000 to $220,000 over the investment lifetime. The investment is not better, the tax structure around it is. Marcus maximized his Roth IRA every single year from 2015 forward, $6,000 per year. $7,000 after age 50, quietly, automatically, without thinking about it. By 2025, his Roth IRA, invested in the exact same S&P 500 index fund Daniel owned, was worth approximately $112,000, tax-free, every dollar, forever. Daniel's equivalent portfolio in a standard taxable brokerage account was worth $107,000 gross, but net of the taxes he would owe on selling, closer to $89,000 in real spendable wealth. Same investment, same index fund, Marcus $112,000 tax-free, Daniel $89,000 effective. The difference is not returns. The difference is structure. And then there is investment number one, the one that made everything else possible for Marcus, and the one that most financial content will never tell you is the highest returning investment available to almost any person at almost any income level. Investment number one, investing in yourself. In 2015, when both Daniel and Marcus had $50,000, Marcus did something before he did anything else. He spent $3,200 on a commercial cleaning business operations course and certification program. Then he spent $800 on a sales and client acquisition workshop, $4,000 total, less than 10% of his savings. That $4,000 gave him the knowledge to start his business properly, to price his services correctly, to acquire contracts systematically, to build a company that generated $140,000 in annual profit within 4 years. The return on that $4,000, measured by the additional income it generated, was not 10%, it was not 20%, it was not 50%, it was thousands of percent. Here's the framework that makes this concrete. Every skill that increases your earning power by $10,000 per year generates $300,000 in additional lifetime income over a 30-year career. A $3,000 course that teaches you a skill worth $10,000 more per year has a return on investment of 10,000% over a career lifetime. No index fund has ever done that. No treasury bill has ever done that. No rental property has ever done that. The highest returning investment in your life is almost always the one you make in your own capability. This is what the financial industry does not tell you because you cannot buy a mutual fund of skills. You cannot automate skill development into a monthly contribution. You cannot put it in a pie chart. So it gets ignored in favor of products that generate management fees. But Marcus understood it, and it is why he reached financial freedom 3 years before Daniel, not because he found a secret investment, because he stacked 5 strategies that worked together, each one amplifying the others. The cleaning business, funded by smart initial learning, generated the cash flow. That cash flow funded the duplex. The duplex provided stability when the business struggled. The Roth IRA sheltered the stock market gains from taxes. The treasury bills provided the psychological foundation to take intelligent risks everywhere else. None of these 5 investments is better than the stock market in every situation for every person. What they are better suited to specific goals, specific life situations, and specific tax circumstances that the standard advice ignores completely. Remember those two people we started with. Same city, same $50,000, same year. Daniel did everything right by conventional wisdom. Index fund, set it and forget it, 10 years of compounding. Marcus did something different. He built 5 streams instead of 1. He used leverage. He protected his gains from taxes. He invested in his own capability before anything else. By 2025, Daniel had a healthy portfolio. He was proud of it. He should be. Marcus had financial freedom 3 years earlier than Daniel, and the gap between them had nothing to do with intelligence, luck, or income. It had everything to do with understanding that the stock market is one tool, not the only tool, and that investors who build the most wealth are almost never the ones who found the best single investment. They are the ones who understood how multiple investments work together, how tax structure multiplies returns, how leverage amplifies real estate gains, how a business generates returns that no publicly traded asset can match, how the skills you build today compound into income for the next 30 years. The stock market is not the enemy. It is simply not the whole story. And now you know what the rest of the story looks like. But here is the question this video did not answer. How do the ultra-wealthy protect the gains from all 5 of these investments once they build them? Because Marcus building wealth is one thing, Marcus keeping it and passing it to his children without losing 40% to taxes is an entirely different challenge. The answer involves structures most people have never heard of. Private placement life insurance that compounds gains completely tax-free. Farmland acquired through nested corporate entities. Litigation finance generating 20% uncorrelated returns. The 5 investments we covered today are how you build wealth. The structures in the next video are how you keep it across generations.